Most option traders obsess over direction, bull or bear. That is it. They pick the stock, they pick the strike, they place the order, and then they are surprised when the stock moves exactly where they predicted and they still lose money on the trade. This video is about the one thing they skipped. It takes 10 seconds to check. Most traders never bother. 4 letters, IVP. By the end of this video, you will never place an options trade without checking it first. Quick note before we go, everything in this video is for education only. I am not SEBI registered. I am documenting my own real trades, not giving investment advice. Full disclaimer in the description. Now let us get into it. Before IVP, you need to understand IV, implied volatility. Most people confuse it with historical volatility, which measures past price movements. IV is different. IV is forward looking. IV is the market's expectation right now of how much a stock will move in the future. It is not calculated from past price. It is derived from the option premium itself. When option buyers are willing to pay more, IV rises. When they pay less, IV falls. Think about what happens the day before earnings results. Nobody knows the outcome. Traders rush in to buy calls and puts. That demand pushes premiums up. IV spikes, sometimes doubles. The day after results, the uncertainty is gone. Direction is known. Nobody needs those expensive options anymore. Premiums collapse. This collapse, IV falling sharply, is called IV crush. And here is the brutal part. A stock can move exactly in your predicted direction and you can still lose money because IV crush destroys the options value faster than the stock's move can rebuild it. One confusion I see constantly. VIX and IV are not the same thing. VIX is a market-wide fear index. It measures the expected volatility of Nifty 50 as a whole. When VIX is 12, the market is calm. When VIX is 22, the market is nervous. I use VIX as an entry gate. I only trade when VIX is below 20. IV is stock specific. Infosys has its own IV. DLF has its own IV. Reliance has its own IV. IV tells you how expensive or cheap the options for that specific stock are right now. You use both. VIX gates the trade. IV shapes the structure. Two different tools, two different decisions. Now, IVP, IV percentile. IV changes every single day. Yesterday, DLF AFI was 30. Today, it is 45. Is 45 high or low for DLF? You cannot answer that without context. A number without context is meaningless. IVP gives you the context. It answers one question. Where does today's IV sit relative to every trading day in the last 52 weeks? Here is how to read it. IVP 80 means today's IV is higher than 80 out of every 100 days in the past year. Options are expensive. You are buying at peak level premium. IVP 20 means today's IV is lower than 80 out of every 100 days in the past year. Options are cheap, premium is near its yearly floor. IVP 50 means exactly the middle, neither expensive nor cheap. One number. Instant context. Opstra calculates it for you. No math required. Opstra is free. No sign up needed for the basic reading. Go to opstra.fintools.in. Type your stock name in the search bar at the top. The option chain loads. Look at the header row above the chain. You will see two numbers side by side, current IV and IVP. That is it. Before every trade, Opstra, search stock, read IVP. 10 seconds. One important note, always read IVP from the nearest active expiry. Far month expiry IV reads differently and will mislead you. Stick to current month or nearest weekly expiry. There are 4 zones, each with a different response. Here they are clearly. Zone 1, IVP 0 to 30, options cheap, buying naked is justified. Zone 2, IVP 30 to 60, normal conditions, debit spread is the standard. Zone 3, IVP 60 to 80, options expensive, spread only, never naked. Zone 4, IVP above 80, extreme. Consider selling premium via credit spreads. I follow this table without exception, not as a suggestion, as a rule. Every trade on this channel is structured according to which zone IVP falls in. You can verify this in every trade journal video I post. Let me show you exactly how IV crush destroys a trade with actual numbers. TATASTEEL, you are bullish. Stock at 150 rupees. IVP is 72. You ignore IVP and buy the naked ATM 150 call option at 8 rupees per share. 150 lot size, capital deployed 8 times 1500, 12,000 rupees. 3 days later, stock moves to 154. That is a 2.7% gain. Exactly what you predicted. You check your position. 150 call option is now worth 7 rupees 50. You are down 750 rupees, right on direction. Loss in the account. What happened? Delta gave you 1 rupee 50 gain from the stock's 4 rupee move, but IV dropped from 72 to 55 over those 3 days. Vega cost you 2 rupees per share. Net, minus 50 paise per share. You were right, you lost. Now the same trade done correctly. IVP 72, Zone 3, spread only. Buy 150 call option at 8, sell 155 call option at 450. Net debit 350.
Break even 153.50 instead of 158. When IV drops, both your long and short leg lose vigor. The short leg partially cancels the long. You are hedged against IV, not perfectly, but enough.
Now flip it. IVP 18, Zone 1, options cheap, same TATASTEEL, same setup, but this time IV is near its yearly floor. ATM 150, call option costs 4 rupees, exactly half what it cost at IVP 72. You buy naked, 4 times 1500, 6000 rupees deployed. Stock moves to 154, same 4 rupee move. What happens this time? Delta gives you 1 rupee 50, same as before. But now IV expands from 18 to 30 as the stock starts moving. That IV expansion adds 1 rupee per share through Vega. Total gain 2 rupees 50 per share. Option price 650, up 62%. Two things working for you: direction and volatility expansion. This is why low IVP favors buyers. The naked buy at low IVP is not reckless, it is calculated. The most common mistake I see, traders confuse IV with IVP. They see IV equals 45 and say that is high, I should spread. But if the stock's IV has been between 40 and 80 all year, IVP might be 20. 45 is actually cheap for that stock. Buying naked is the right call. Second mistake, checking IVP only at entry and forgetting it exists. If you entered at IVP 25 and IV has now expanded to IVP 70, your position profile has changed. Your long option is now expensive. Your target exit becomes more urgent. IVP at entry shapes the structure. IVP changes during the trade should be monitored. Third mistake, applying market VIX rules to individual stock. IV. VIX 12 does not mean every stock's IV is low. Stocks have their own IV cycles. A stock in results season can have IVP 90 when VIX is 11. Check VIX for the market, check Opstra for the stock, both, always. Let me show you this working in a real trade on this account. July 5th, DLF, realty sector was the top mover of the day. Before placing any order, 10 seconds on Opstra, DLF IVP 71.03, Zone 3, options expensive, no naked buying. The instinct was to buy a naked 670 call option priced at 20 rupees. IVP table said no, spread only. I bought 670 call option at 20 rupees and sold 700 call option at 815. Net debit 1185. What changed? Break even dropped from DLF 690 to DLF 681.85, 8 rupees lower. If IV had crushed 20% after entry, the short leg would have absorbed part of that loss. The downside was capped at 1185 regardless of what IV did. One 10-second check, same view, same direction, half the risk on break even. That is IVP at work. Three things to take from this video. These are the only three you need. 1. IV tells you how expensive options are today. IVP tells you whether that is historically high or low. Never use IV alone. Context is everything. 2. Zone drives structure. Below 30, buy freely. 30 to 60, debit spread. 60 to 80, spread only, no naked. Above 80, consider credit. 3. 10 seconds on Opstra before every trade. Search stock, nearest expiry, read IVP, pick your zone, place the trade. That sequence does not change, ever. In my automated scanner, IVP is gate 4 of 9 checks. Gate 1, sector in top or bottom 2 movers of the day. Gate 2, stock confirms sector direction, same directional move. Gate 3, VIX below 20, market safe to trade. Gate 4, IVP check, which zone, which structure. If IVP is above 80 and I have no credit setup ready, I skip the trade entirely. A clean directional view in a wrong volatility environment is still a bad trade. Both must align, direction and volatility environment. Next video, how I rank 13 sectors every afternoon to find the single strongest setup. That is the gate 1 logic behind the entire 3 p.m. system. Subscribe so you do not miss it. Drop a comment below. What is the IVP on your watch list stock right now? I read every comment and I will reply. Real trades, real P&L. See you at 3 p.m.